Hey everybody, welcome back to the weekly market review for the week ending April 26th, 2024. Uh, we'll be looking at the markets today, which have bounced pretty strongly this week, and take a look at whether or not the bounce is going to continue into next week, or if this is the top of this move, or I guess also if the pullback is over and if we're going to move back to the upside. But before we jump into it, I want to take a moment to remind you to hit the like button and subscribe to the channel if you have not already. You can also follow me on Twitter at Mr. J. Thomason. You can also follow my free in 2024 weekly newsletter at befinanciallyfree.substack.com. And I just want to make a little plug here. If you were to go to my Substack, the link is in the description below, and you were to go, you'd find my weekend thoughts. I write a little blurb about what I'm thinking about this weekend, as well as the summary and outlook, which is the summary of all of the research and all of the analysis that I do on my weekends on the markets. And in that, you will find, for example, the prediction for the week ahead. And I say prediction, but it's an informed guess about the probability of the direction. It's not a price target. It's not a prediction in the sense of playing the lottery and making a wild guess. This is all researched. It's all very well thought out. I look at a lot of different things in the markets, and I've been on a really good streak. And it's not to say that it's always going to be this way, but I would, I want to proudly point out that for a very significant amount of 2024, here we are in April 26th. In 2024, the newsletter has had a well over 75% odds of calling the right direction, pathway in markets in the next week following. And so that's something I'm very proud of. Obviously, over the last week, this last Sunday, when the newsletter came out, I discussed the likely direction. It has an upside bias. I do use the word uncertain because I also incorporate conviction level, where this week was not super high conviction, and we'll talk about why in just a minute. But that definitely there was an upside bias. So we'll take a look at the weekly. This week, S&P 500 futures were up 2.5%. NASDAQ up 3.87% in the futures. Russell up 2.68%. You can see there's obviously some boxes and some lines on some of these charts we'll talk about. But the question that I was kind of alluding to is why would I say if my market directional call was to the upside, why would I say it's uncertain? Why was the conviction level low? Well, I talked about this a little bit last week in my video. I'd encourage you to check out last week's video, which was a really good video to really good analysis of the market in the midst of a drop. And one of the things that I talked about, which kind of led to my upside conviction, was if I pull up my charts specifically, so you can see on the S&P on the lower half, you can see the RSI. The RSI on Friday at the close ended at 30.35, not quite at the oversold level. I think it's too easy to get a little too consumed with the idea that, oh, it's not oversold if it doesn't hit 30 exactly, or if it doesn't get below 30. But even if you were looking at the S&P futures, which is I tend to look at the futures because they trade longer than the SPY or SPX. But if you go to the NASDAQ futures, those did hit oversold. You see on the RSI, if you want to be technical about it, the RSI hit 29.14. And I talked about this, I think I talked about this in my in my video, that the NASDAQ, when it's oversold, meaning once it hits 30 or below, it has a 75+% win rate on the long side, meaning that if on the close, if you bought NASDAQ when the RSI hit 30 or below, then 75% or more of the time, a long trade would be in profit within the next day or two, usually within the next day, and often for the course of at least a few days, and perhaps longer sometimes. And so I pointed that out. I pointed it out on Twitter. I pointed it out, I believe, on my video. And again, NASDAQ on the week, on the futures, is up 3.87%. To put that into perspective, if we take a look at, oops, pardon me, sorry about that. If we take a look at, if you had bought NASDAQ on the close, exactly on the close of markets last week, 665 points have been gained. And so if you had one futures contract on the NASDAQ long, then you made a little over $12,000 in a week. So I don't know about you guys, but that's good money. So just something to point out in terms of these kinds of signals, right? And so you have to, whenever you're doing any market research, whenever you're trying to think about probabilities, you need to go back and you actually need to test these things out, right? I mean, even during the summer correction last year in 2023, the NASDAQ didn't hit, the futures didn't hit an oversold, and they still got good bounces. So the last time we hit an oversold on the NASDAQ was back in, October, September of 2022, and we got bounces back then. So this is a pretty good, honestly, risk to reward and high probability trade to the long side. So I just want to point that out. So despite the fact that directionally I was pretty certain that it was going to go to the upside, the conviction level was low because the RSI, while it is a good indicator in terms of finding bottoms, it's not perfect. And that's key to point out. And it's only one data point. And so there are other data points I look at, like I'll pull up my stocks trading above their 50-day moving average. This is a really good coincident near-term indicator. And on Friday last week, I was kind of looking across the week to see if we would get some downside, some further. We got a lot of downside. Don't get me wrong. But I wondered if we would get further downside, if we would move down below 20 before the end of the week. And we actually curled upward, which meant that the greatest degree of weight to the downside was from mega caps. And so the short-term momentum indicator was not confirming of the oversold directional reading. Although on the flip side, you could also say, well, because this started to curl up, that actually showed that the majority of this S&P 500 stocks were performing. It just wasn't the largest cap, and that's actually true. The performance, if we go to the NASDAQ chart, the performance of the large cap did go down, and this one actually went down. I have this chart also, NASDAQ 100 stocks above their 50-day moving average. And the extremes are a little bit more narrow here, at least from the bottom side. We got really close to the 15 level, which tends to be the historical extreme downside level on this metric. So that did suggest further upside, but the S&P 50-day stocks above 50-day moving average chart didn't support that. So there wasn't a whole lot of conviction there, or for that reason. The other thing was that the VIX, while having closed down significantly from its highs, did close up versus the close on Thursday. And so I wasn't certain if there would be further volatility to the upside. The other thing being that the dollar was consolidating, and it wasn't certain if it was going to break higher. The 10-year was obviously pretty well elevated above 4.6%. And it had actually, if you look at last Friday's price action on the 10-year, you could see that really large wick down. If I move my mouse, you could see the wick down. And then it closed almost near unchanged. And I wasn't sure across the week if yields would rocket to the upside. So my point is that like I believed the direction was to the upside, but the conviction level wasn't as high as it would have been otherwise. I can give you a different example. If you go back to Friday, October 27th, uh, I believe I had a video posted that day. I put this in my video, that we were not only oversold on the RSI, but if you go to the stocks trading above their 50-day moving average, uh, for a time, we didn't close below, but we went below the 10 level, which is the extreme. Which is the extreme. And there were a whole bunch of other issues of, like, if we go back to the VIX, and go back to, let's see, it was late October. The VIX was coming off. It had actually gone down. It was closing off of its highs of the week. And then, of course, you had, on the 10-year, by the time you get to the end of October, yields were going sideways rather than up. So there was just a lot more that was going to, and that's not including, there was also the AAII bulls bears spread and the bearish sentiment, which were at really, really significant extremes. And so all that is to say, the conviction level wasn't as high on this close on the end of the week, because for the newsletter at least, because the only thing that was suggestive of a bottom was the RSI. And so on that note, that's one of those things where the lesson for anyone who's watching, is that you can't take one indicator. You have to take a large number of indicators and decipher what is the story being told by the compendium of different signals, right? Rather than just looking at one signal. And so the question now then is where are we going? Where are we going from here? So in order to analyze this, so I've got these three boxes. I've been kind of fiddling with where these boxes have been located over the last couple of weeks. But this is generally the map for the direction of the market. And just to give you an idea, if you want to do a fractal analysis, all I did was I took the fractal from the summer correction. It's not perfect, no fractal is, but I just overlaid it with the with current price action. This is just from the last time I did it. It took me like 5 seconds to do, so obviously I didn't try to fit it exactly, but I just changed a little bit of the depth of it just to make it fit a little bit better. But you can kind of see, like, the path from here makes sense that it would come back up pretty close to its previous highs. That tends to happen whenever you have corrections. This is why shorting is so hard, because the bounces off corrections are so fierce. And so in theory, this thing could come, to within 100 points or so of the, or maybe within 200 points, 100 or 200 points of the previous all-time high, before jumping down again and getting just a little bit lower. My base case for this correction is minimum 7%, maximum 11%. And so if you look, if you were to do a little measurement here from the closing top, you can kind of see that 7%, 7 to 7.5% is about the middle of this middle white box. And then you get to about 11% once you get into the bottom box. That's kind of the range I'm looking at. That would be like normal corrective behavior, and that would fit the fractal, which again, it's not about, I'm not saying that the fractal is supreme or anything, but it's one way of trying to look at the market. There are other ways you could think about the market. For example, it looks somewhat similar to what was going on in late 2021. If I zoom in on this a little bit, right around here, September 2021, the markets had just been going up, 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 and then you had kind of a turnover, a little bit of a bounce, came down. This correction, this pullback was only about 5% or so, 5-6%, before moving higher to more further all-time highs. That's a possibility. And so I want to be aware of that. This thing could always just go right back up. And so this is a situation where the rule of thumb, if you're looking at this from a risk management perspective, is once you got that RSI reading, then you're not trying to short the market anymore. And you're just kind of watching to see kind of how this unfolds. So the signal, there's a couple of different signals. You can see the MACD down here is getting close to crossing back to positive. Um, I'm not sure if that's going to be a good enough signal because it did that also in the summer 2023 correction. It did that back in August, right before reaching its little peak. Um, you can also see that the RSI right now is below the 50 level, which is below the midpoint. But in the summer correction, it did jump above on both of its little bounces. It jumped above the 50 level. So you do have a little bit more room to the upside. Now, because we've gone so long without corrective behavior and the move has been so fierce, I do believe we're going to get 7 to 10% or 7 to 11%. But this thing could take until June or July to play out. These corrections don't take place immediately and over the near term. So, what I will be watching for, and actually we can turn on some moving averages for this. What I would say is, what I'm wondering is, are we gonna hold above the 50-day moving averages, which is the blue line here? If we can hold for a period of days above the 50-day, then that's the signal that this is actually about to move back further to the upside. You can actually see we got a clean touch on the 100-day moving average. And so I think that that's something to watch out for. If we roll over here, then I suspect that the 200-day moving average is going to get tested, and by the time we get there, the 200-day moving average should be up a little bit closer to the middle white box, which would line up pretty perfectly. So my base case here is that we're still going to see some upside into next week. Next week, we've got a couple of news catalysts. We've got some ISM data. We've got a whole plethora of jobs data that's coming out throughout the week. And we have the Tuesday, Wednesday FOMC meeting, which culminates in the rate decision press release as well as the Powell press conference. And so that could be a catalyst for upside, or it could be a catalyst for downside. Obviously, a week ago, Powell discussed that. Was it maybe a week or a week and a half ago? Powell discussed that they are disappointed by the inflation data and that they're not seeing the progress that they believed was necessary. And so it makes you wonder if there's going to be if he's going to be more hawkish, and if the presser is going to be more hawkish, and I'm sorry, if the press release is going to be more hawkish this year. So there's a lot of uncertainty. So this is the kind of situation where my newsletter will probably start off by saying that there is uncertainty about the week ahead. In any case, my current base case is that the beginning of the week, because of momentum from Microsoft and Google earnings, as well as anticipation of upcoming Mag 7 earnings, just the relative positive note with which we ended the market. I mean, this is the strongest week that we've had in 2023. Not the strongest week that we've had ever, or even over the last year, last 12 months, but this is the strongest of 2023 so far. And I think that market excitement is bound to continue into next week. So I think we're going to bounce. But I think by the end of the week, we will start heading down further. And it remains to be seen. I don't know if that means, in my base case, I'm not sure if that means that we're going to be lower by the end of the week than where we started, or if we'll just be beginning the move downward. But that's kind of my base case. But obviously, it's only Friday, so I'm going to reserve judgment until I've done a little bit more research. This is just my quick view of the market right now. So that's kind of where I'm at on stocks. A couple of things that I wanted to look at. I don't normally, or haven't been for a while, doing much looking outside of the stock market because that's been most interesting leading into this correction. But one of the things that I'm noticing is on the dollar. If you look at positioning, like futures positioning, the dollar is pretty heavy in terms of positioning. That doesn't necessarily mean it has to reverse. It just means that the risk to reward is not as great. But I do want to note the uptrend is getting stronger, and I mean some people may be calling this a bull flag right here, something like that. That's a really crappy drawing. I'm sorry about that. But just in a general sense, a lot of people are pointing that out like it's a bull flag. So a consolidation and a bullish uptrend, which is usually bullish. We had a really strong day today. Interesting. That's kind of one of the things that's kind of interesting about the market today. The dollar was up, the 10-year was down, risk assets were up, uh, Bitcoin was down, and so not really sure what to make of that. Having said that, it kind of feels like the dollar, though maybe the dollar futures are crowded, or maybe the dollar, the futures are crowded in a way that is favorable to the dollar, or maybe that is skewed towards the dollar. But right now, it kind of feels like the dollar needs to or wants to move higher. And I think markets will start to get a little concerned if the dollar can break above its 107 peak from over last summer. If you look, it was basically the entire month of October, the dollar spent around the 107 or just under the 107 level. Markets obviously were correcting at that point. So further dollar upside is probably going to be not a good thing. You can see on the RSI on the dollar that we still have some room before to go to the upside before anything is overbought. You can see the MACD. If you look at the histogram here, we did we did cross to the downside, but the momentum is heading back to the upside, and so pulling it back. If you want to look at the late 2022 run, the MACD and the RSI can stay elevated, and price can continue to move up steeply for a very long time. So I think that that's something to be aware of. One of the things I think that can affect this is that market participants have largely been expecting rate cuts, especially ever since December. And what's interesting is what should have been the tell is that it was Wednesday the 13th that Powell talked about rate cuts. The dollar fell almost a whole percent. But by the time the month was over, it had already bottomed and started moving back up. And despite the fact that, even at the beginning of the year, there were 6 or 7 rate cuts that were being priced, and the dollar continued to move higher. So I think as the market considers the potential that the Fed won't cut rates, I think there's room for the dollar to move even higher in this case. And then as far as yields go, I mean, yields are almost overbought, but there is a ton of room if needed. If I mean, it can happen. Yields could go further to the upside. We're almost at my goal. We got basically 1 point. Let's see, what is that? What's the high on that? We got 1.1 basis points away from when I drew this line. Now, I don't know if any of you guys were watching this channel. If I put the tide indicator back up, when we first got this confirmed cross back in February, I had started talking about it on Twitter and in my videos back in January. But once we confirmed that cross in February, that was, I mean, think about this. Yields were at 4.25%. And I said 4.75% was the target, the minimum target if we made a tide cross, if that tide cross is indeed confirmed. And that's, I mean, we were so close to it. I mean, I'm willing to, I mean, if we want to be technical, no, I didn't get there, but we basically did. So in my book, we reached the goal that I thought we would get to. And so I'm okay. Like I'm not in the bonds right now. So, I've got no skin in the game. So if this wants to come off a considerable degree, power to everyone who's in bonds. But I think the concern is that there's room for further movement to the upside. If you look at the tide line, we're a little bit stretched in terms of the distance away from the timeline, the tide line, but there is plenty of upside momentum for this thing to keep going. And I don't know how far it would go. I've got no target. Once we've gotten to this point, I've got no target beyond that. So I'm comfortable with it stopping there, but I also know that things can move a lot quicker and a lot further than people think. So 5.5% wouldn't surprise me one bit. I'm not calling for it, but it wouldn't surprise me one bit. But you have to remember, it's also not going to go in a straight line. And then the other thing I want to talk about is crypto, specifically Bitcoin. I've got a couple of trend lines, a couple of things going on here. I would call out, if you go back to my newsletter, I talk about it a little bit in my most recent issue, but if you go to the one from April 14th, talked a lot about Bitcoin in this. And then I did an analysis on the consolidation periods around the halving, which has obviously been a big thing in markets, in the crypto market recently. So we had the halving happen last Friday, very late in the evening, maybe Saturday morning. I have it on Friday. And essentially, the summary of it is that the average or the minimum time around consolidations around the halving, if you want to take the lowest number possible, is 81 days, which means that if you go from kind of the top in March and you go 81 days, it means that this thing could take until June to make a new high. That doesn't mean that it's just going to, I mean, it doesn't mean that price has got to go down for that 81 days. A lot of times what happens is it comes down and then spends some time moving kind of up like this, and then it'll consolidate right below the other the previous high, and then it'll rocket off like that. So I'm not sure. I've got no take on how that's going to happen, but I just want to call out that a lot of people who, like, frankly, and I've gone on rants on this lately, so maybe I'll try not to rant as much. I know I talked about this last week, but all these people who honestly, frankly, probably don't care about whether or not they're actually right or wrong because they make money off of their subscriptions and on their engagement, have been telling you on crypto, oh, buy now because it's Bitcoin is going to go to X dollars tomorrow or a month from now. Or I think I brought up previously the whole idea that, once Bitcoin breaks its all-time high, it goes up 100% more in 30 days. And I mean, we are beyond that. All right. Like, I mean, if we go to when Bitcoin breached its all-time high originally, we're 53 days past that. So obviously they were wrong. And I think there could be all kinds of cycle dynamics that were different this time versus last time. I don't know. All I know is that Bitcoin is consolidating. This stuff takes time. It often takes far more time than you think it will, or than you think it needs to. And my base case, like, frankly, I'm long Bitcoin. I've been long Bitcoin for a long time. I have a core position. I don't have a trading position in Bitcoin right now. Actually, it's kind of funny. Bitcoin's trading 48 currently, as I'm looking at it, about $48, $51 above where I sold my trading position. And it's funny because when I sold, you could find it on Twitter. I posted about it literally when I did it. And people messaged me asking me, oh, are you serious? Like, how could you? The ETFs and, it's going to go 100% higher after the all-time high. And it's funny because here we are, like, how many days later? We are 60 days past when I did that. And the price is at basically the same level. So this stuff takes a long time. My base case on this is that we have to get to the point where the large percentage of crypto investors believe or start talking about the having been already priced in. Once that becomes the consensus, that's when the Bitcoin bull market is going to break out further. Until then, though, people have been every day counting up the inflows from the ETFs. Well, guess what? The ETF inflows are negative. BlackRock doesn't have any inflows for like 2 or 3 days in a row. Fidelity's Bitcoin ETF inflows were negative, I think, yesterday or something like that. So once people, like, this has to be like something that people stop talking about before it's going to take off. This is just psychology. This is not rocket science. It's psychology. So, and maybe I'm wrong about this. Maybe by the time we get to Sunday when my newsletter posts, we'll be back towards the all-time high. That could totally happen. But my suspicion is that we have to give back some price, and that we have to give some time before, and so that sentiment can wash out. Again, not necessarily price, but sentiment needs to wash out before we can move much higher. So in terms of Bitcoin, I've got a couple of different trend lines I want to point out. I've got a couple of really faint trend lines. I don't know if you can see that. That's kind of the base trend line from the lows. We obviously don't want to violate that ever. Otherwise, there's big time danger. Then I've got the first steep bull market breakout trend line. So again, this is the lows trend line. This is the breakout trend line. And then I've got the this trend line, which it's only got basically one touch right now. I'm sorry, I need to be on log scale. There we go. Okay. I mean, it works both ways, frankly. Actually, that means I'm going to need to get rid of that one. Let me get it off log scale because I think this works. So I'm kind of watching to see what happens at these different trend lines. So I've got those in terms of like the uptrend, and then I've got a flag pattern that I've been kind of watching for a little bit. And this is obviously a sideways flagging consolidation in an uptrend. So it should be bullish. Obviously, anything can happen, but it should be bullish. And so I'll be watching to see how price interacts with the bottom and upper trend lines, as well as these uptrend trend lines that I've been watching. But anyway, I just thought I would take a minute to look at a few other markets because I haven't been doing that for a little while. And then finally, I know I'm about 30 minutes, so thanks for staying with me if you're with me. But the last thing I wanted to do is look at the 10-year 3-month yield curve. I've been pretty consistent in watching this yield curve specifically. And it's quite like I hear nobody talking about it. Everyone's talking about 2s, 10s, which has basically just been sideways since October. But the 2s, 10s is very quietly getting up to near the same levels it was at the peak, or I'm sorry, not at the bond yield peak back in October. At the lows of the stock market and at the highs of the most recent highs of the bond yields. And nobody's talking about this. And this is concerning because it's the 10-year 3-month that has the flawless, perfect record of predicting recessions. And some of you guys, if you've seen my newsletter or watched my videos for long enough, then you know that I did a study on the tide line, on using my tide strategy, looking at the 10-year 3-month yield curve across its history. And we had a false signal, which is, I mean, there are occasional false signals that have happened, but they're quite rare. But just to summarize, in an inverted yield curve environment, once you get a bullish tide cross on the yield curve, you basically have about a 30-day window before buying TLT becomes before it's the prime time to buy the TLT ETF or buy the long bond, I should say. And then usually that tide cross means that you have a median and average time span of about 3 months before you actually see a recession. And so what does that mean? That means that from this moment, 30 days is, let's see, that's early May 6th, around May 6th, Monday, May 6th. So in theory, that would be the best time to buy TLT. And then about 3 months later, so about 90 days, that puts us in July. That would, in theory, mean that that's the average and median time before a recession begins to take place. And when I say a recession begins, what I'm talking about is, the NBER declares recessions. Usually they do it retroactively. But what I found is that the yield curve and the tide indicator together more often than not demonstrate that it will match up with when the NBER says the recession began. And so I guess my point is let me put a line. Maybe I'll put a line so that this is more clear. So let me get, here's the cross, and then I want to go about 90 days. So here's about 90 days. So let's see, that's in August, right? So what this means is we will, in theory, like yield curve is going to kind of move along here. Maybe it'll invert or revert back above zero, yada, yada. And then at some point into the future, the NBER, this is really bad writing because I'm using my mouse. The NBER will say, oh, back here, a recession started. That's kind of what I'm talking about. The yield curve, along with the tide indicator, tends to very like tends to be coincident with the beginnings of the recessions according to when the NBER says that they began, right? So I don't have to wait, I don't think, if this is going to be accurate again, and I'm going to, until this thing fails, and I mean I guess it sort of failed here, but until it fails, I'm going to assume that it's telling me the right thing. I don't have to wait for the NBER to tell me that a recession started 6 months ago. I can actually see it ahead of time. So I just wanted to include that. I think that that's going to be really helpful and informative for anybody who's watching. And now I know I'm way over time, so I'm going to stop there. But I hope you enjoyed this, and I hope you have a great weekend. I'll see you guys next time.